Hello, fellow Rebel Capitals. Hope you're well. I'm here with George Selgin from the Cato Institute, the one and only. George, thank you for coming on the Rebel Capital Show. I really appreciate it.
It's a pleasure to be on the show, George. Thank you.
Usually I'm just talking to kind of the hedge fund types, and they're kind of knuckle draggers at the end of the day is what we call them. So it's nice to talk to someone who's actually smart and qualified.
Well, I hope it looks that way after the show.
So you did a paper on discussion of if banks are intermediaries and how they create money. And what I thought was most important is how they settle.
Yes.
And I almost flunked out of high school, George. I've never taken an econ class or a finance class in my life. I'm just kind of a schmuck on YouTube, just trying to figure this stuff out. But when I was reading your paper and you were referencing some other papers that were arguing for banks not being intermediaries, so you called thin air bank, I could not believe that they didn't go over the settlement process, because for me that's the only thing that matters. That's where rubber meets the road. So on that note, if you could go ahead and kind of give a summary of the paper and your view, and then we'll kind of go back and forth.
Sure. Well, the paper is part of a long-standing debate. This goes back almost as far as you like. You can trace this debate, which is a debate between those who claim that banks have to borrow from others in order to lend themselves, which is what it means to be an intermediary, right? You're not lending resources you create yourself. You're borrowing from one party or parties, and then you are turning around and making loans using the borrowed funds. That's one side of the debate. That's one view. That's the view I take, that says they are intermediaries. The other view, which I'm criticizing, is the view that because banks can create money, and they do create most of the money we use today, that means they don't have to borrow, and in fact do not borrow in order to lend. They use their money creating capacity to create whatever funds they make available to people who borrow from them. So that's the view that banks are not intermediaries. Now, I should say, my paper specifically takes on one relatively recent contribution to the banks aren't intermediaries side of this debate, and that's a frequently cited working paper from a couple fellows published by the Bank of England. So it's not a Bank of England paper in the sense it's not giving the official view of the Bank of England on this debate, but it is published by them, and it has therefore got a certain cachet that not all publications in this debate have, one that causes it to be taken very seriously.
Is that 2014 paper?
That's right, in one iteration of it, and the result by Jacob and Kumov are the authors. The consequence of the prominence of the Bank of England and having it be associated with this paper is that now that paper is the source most frequently cited by critics of the intermediation view, who say, look, even the Bank of England takes our side, and cite that paper. So I chose, rather than to try to take on the whole gamut of criticisms of the banks as intermediaries view, to simply focus on that paper. If it's cited as the best thing there is on that side of the debate, well, then by taking it on, I felt I could make an important contribution to the other side.
I want to be a little more specific there, because when you say that banks need to borrow in order to sell, I think it's important that we differentiate between borrowing bank reserves and then just borrowing from one another.
Yeah, that's right. Well, we're not talking just, banks can borrow from any number of sources to fund the lending that they do. And I should say, a lot of the problems with the position that banks are intermediaries have to do with the fact that it's not always defended correctly. And so I have to expose what I consider some fallacies on that side of the debate, while also criticizing the opposite side, the Cometh and Jacob side. So banks, my position is banks don't create the funds they lend out of thin air. They have to borrow in order to lend. That's except for their own capital. That's the one exception. Beyond that, any lending they do, they've got to borrow. They have to fund it by acquiring funds from others. Now, they do borrow from ordinary persons, from their depositors, most obviously. They borrow from them, but that's not all. They can borrow from other banks. Usually they do that only to cover themselves in the short run, because it tends to be expensive. And of course, they sometimes borrow from central banks. But again, my view is one way or the other, when they make a loan, if a bank lends somebody, let's say 10 grand, it has financed that loan, or it has to finance that loan by borrowing 10 grand from somebody or some collection of others. That is my position that I defend in that paper.
Right. So what I want to drill down on is if a bank, let's say in a settlement process, and I use a little bit different terminology just because, I don't really have an educational background. So I just had to kind of think through this stuff on my own. So when I think about a settlement process, I just think about a commercial bank transferring a deposit liability to another commercial bank. So the fact that they're transferring a liability means that they also have to transfer an asset, or they have to reduce the receiving bank's liabilities by the amount they sent. So, or the sending bank has to increase the receiving bank's balance that they have with the sending bank. So in that process that I just outlined, there was only one of those that involved, let's just call it M0 or base money, right? And so if those other two settlement processes did not involve any base money. And so I'm trying to really understand your position thoroughly.
Yeah.
When you say borrow, are you referring to the banks having to borrow bank reserves or M0, basically a liability to the Fed, or are you just saying they just have to borrow in general, even if it's credit creation from another bank?
In a sense, George, whenever a bank borrows, it borrows access to reserves, even if it doesn't borrow literal reserves. Really, the point is that a bank's lending capacity depends on its ability to get others to hold on to its IOUs to the tune of the amount that it lends.
Yep.
And for certain purposes, that doesn't necessarily mean that reserves come flowing into the bank. Let me give you a simple example. Suppose I want to act as an intermediary using your savings, and I give you an IOU by which to, in exchange for your supplying me with funds, and I can turn around and make a loan to the extent of the amount that I have borrowed from you. Now, banks are doing this all the time. They are responding to an increased willingness to hold on to their IOUs that allows them to expand their own balance sheets to acquire more assets. So it's ultimately the demand for a bank's liabilities, the real demand, purchasing power adjusted. We always have to think about that. That limits their ability to lend. And you focus in your discussion online and elsewhere, you're focusing on clearing and settlement. And that is absolutely the key. One has to focus on that. Let me explain why it's important for the sake of your listeners who may not understand, by starting to tell the phony story that one hears from the people who say banks aren't intermediaries. And that story works like this. I'm a bank. That means I can create deposits. I just write up a credit. So let's say I want to lend you $10,000, and I do that by writing up an account for you. I just credit a bank account to your name, and I give you some blank checks, and I can do that costlessly. So far, I can do it out of thin air. I don't have to have any resources on hand because all I need is a ledger and a blank check book to hand you.
Yeah, the way we say it here, George, is just you're creating deposit liabilities. The offsetting asset is the loan that was just created by the bank.
That's right. That's right. Your loan is the asset. So far, my balance sheet looks like plus $10,000 deposits, which I've created, your deposits, plus $10,000 loan, which is the asset, my loan to you. Now, this all looks wonderful, right? Except people don't borrow from banks in order to keep the deposit balance there and not do a darn thing with it. People borrow at interest, we're assuming, in order to have funds to spend. That's where clearing and settlement comes in. You borrowed the 10 grand, let us say, to go buy a nice car. Well, these days, not such a nice car, a decent used car.
That's a bicycle now, George.
Yeah, a very expensive bicycle. That's even better. So you go and you pay the bicycle store for this nice bicycle. Now they have your check. I know speaking of checks is old fashioned. It could be a debit card, doesn't matter. And what they do is they collect on this sum, which means the item is presented directly or indirectly to their bank. And chances are their bank isn't the same as your bank. That's me. So they send these items in, or they're electronically recorded. And either the Federal Reserve or some private clearing entities, either one can handle this, see to it that my bank settles with you, that I settle with your bank. And that means I have to have some resources on hand to do that, because settlement requires real Federal Reserve dollars that I can't create myself. Sure, I could say to your bank, the bicycle seller's bank, I could say, oh, why don't you just hold on to my IOUs? But they'll say, no, thanks. We're a bank competing with you. We don't make life easy for other banks. We want to have a safe assets final settlement. At that point, I have got to come up with the resources. Now, I might have had 10 grand worth of Fed funds, Federal Reserve balances, already on my balance sheet, in which case I would lose those and the bicycle seller's bank would gain them.
Right. All in the Fed balance sheet.
That's right. So that would be an adverse settlement, adverse clearing with a settlement of 10 grand. And here's another fallacy in the way some people present the loanable funds or the intermediary view. I didn't have to have the 10,000 on hand when I made you the loan, but by gosh, I better come up with it now when that check or whatever gets processed. So I may have made you the loan knowing that the interest rate you're offering me is enough for me to borrow for less. That's sufficient for me to find the loan attractive. In that case, after I make the loan, or about the same time, I'll go scrambling to whatever market I need to borrow the 10 grand for less than I expect the return on my loan to you. But in any event, I had to come up with the equivalent of Federal Reserve dollars in order to settle the check. So I wasn't, after all, able to make you a loan using nothing but thin air. I had to finance the loan with resources borrowed. Either I had 10,000 in reserves on hand, which I presumably had borrowed from my depositors or perhaps from other sources, or I go and get the funding I need by borrowing it. And that means that either way, I'm financing the loan not by my own money creating capacity. It would be nice if that were good and sufficient, but by borrowing. Yeah. That's it.
Let's go through a different example because I'd like to get your take on it.
Yeah.
So let's assume JP Morgan. So almost the equivalent of the Fed as far as the risk profile, right? If you've got a liability of JP Morgan versus a liability of the Fed, it's almost equal. So you got JP Morgan, and they create a loan for, let's just say, $1 million. So now going back to what you're saying, the offsetting asset is the loan they just created, but now they've got an additional deposit liability of $1 million. But that person, to your point, is going to spend the money. So they spend the money. That money has to be transferred to, let's just say, HSBC. So
Right.
that now all of a sudden HSBC has an additional liability.
As a claim on JP Morgan.
Yeah. So why doesn't JP Morgan just increase HSBC's account with JP Morgan by the amount of the deposit liability that was transferred?
Because even though JP Morgan's IOU, which is the alternative asset that
Right.
HSBC could hold, BC could hold, it may be safer than most bank IOUs, than many. It is still not perfectly safe, and holding it does not give HSBC the capacity to make more loans itself.
Yeah, because then what HSBC, but then let's go back to that. So HSBC then transfers that to, let's just say, Wells Fargo. When I say that, I'm talking about that deposit liability, that $1 million.
Then that'll result in a loss of reserve adverse settlement.
Right, but then what JP Morgan does is that Wells Fargo has an account with JP Morgan, Global Dealer Bank. So they just transfer the funds from HSBC's account into Wells Fargo account.
Well, but the problem is what you can't assume, right? There are 10,000 banks and credit unions in the United States. We could talk about transactions that are on us, right? So if you want to, let's make a simpler version, I think, of what you're talking about, which is one where I make a loan to you, you buy the bicycle seller has an account at my bank, right? In that case, there's no 10,000 claim. However, even then, you have to be very careful. The bicycle dealer also doesn't, there are two possibilities here. One is the bicycle dealer wants to hold $10,000 more in his account. Then he's the lender, and I'm still borrowing, but I happen to be borrowing from him. The other, more likely, is that he's going to spend that money eventually on stuff because he didn't want to have that much more extra cash balance. And then we're going to go back and continue. Eventually, this story is going to end with my bank having to fork out some dough in settlement. Can even make a more extreme case. Suppose you did borrow the $10,000 from me and you just held it. Right? You didn't buy a bicycle. You don't buy anything. This is the case that makes life really simple for my bank. But then guess what? You're lending me 10,000. You are, in that case, you are the source of the funds to yourself. You're lending to yourself by holding a balance, an IOU against me, at the same time that I hold an IOU against you. And so one way or the other, we never can get away. There's no story you can tell that's coherent that has me able to make a loan without having to borrow from someone else. And again, what it all boils down to is my capacity to lend is limited by the real demand for my IOUs. That real demand can come from the borrower, in an odd case. It can come from the person the borrower is buying stuff from, because that person decides, gosh, I want to hold some Selgin IOUs. But if it doesn't come from anybody lending me more, if nobody wants to hold my IOUs, I have to come up with reserves. I have to have reserve balances on hand that I can part with for settlement, or I got to see if I can't scrounge around and get somebody to lend 10,000 to me. And no one can tell a story that doesn't involve one of these possibilities that all take you back to banks are intermediaries.
Right. I just think that a lot of banks out there would be just as would be okay with JP Morgan's liabilities.
No, it doesn't work that way. It doesn't work that way, George. Banks do not willy-nilly lend to rival banks. Doesn't happen. They are very jealous. There are very good reasons for this. Actually, Larry White and I talk about it in a paper called The Evolution of a Free Banking System. But the bottom line is banks don't like to accumulate willy-nilly IOUs of other banks that entails some risk. when they can, for practically nothing, convert those IOUs into Fed balances that are absolutely risk-free and more useful for things that you can't use your balance at JP Morgan for, like settling with other banks. So it's kind of a no-brainer if you're a bank. You don't hold your other banks' IOUs. You routinely clear them and settle them, and there's abundant information on this. You can see banks every day constantly settle accounts with one another. They don't just let liabilities that they are holding, items in collection is how they occur on their balance sheets. They don't just pile them up. They send them in and say, pay this every day.
Right. How did they do that prior to QE?
Well, it's always been through a central clearing agency.
But how did they
That's
do that
all.
with bank reserves? Because effectively there were no bank reserves.
Oh, there were just enough. Remember that most settlement, you only need the reserves for the net settlement. I know you know this from your exchange on Twitter. So all these banks every day are sending all the items, demand items that they have collected from other banks back, often many times a day, but at least by the end of the day. Now, of course, after netting, there's going to be a netting process in many cases, uh, in most cases. So at the end of the day, you have the net balances that are owed from certain banks are creditors, certain banks are debtors, and those will be a tiny fraction in a very big economy of the gross interbank dues that occur on that day. That's why banks could get away with very low reserves. What you have today, and since 2008 and all the QE, you have banks sitting on vast amounts of reserves, far more than they need for settlement. But that doesn't mean that the amounts that they held before October 2008 were inadequate to actually settle all the net dues, with banks constantly doing that. And they were quite adequate. Also, remember, you had an active federal funds market. What's that? Well, that's a market where, at the end of the day, if a bank found itself short, it could borrow from any bank that had a little excess at the end of the day. A very efficient market. And that too contributed to the very low reserve ratios. Banks were getting by with 3% reserve balances, let's say roughly, but that's what they needed. By the way, this is nothing new. If you go back to the days of the Scottish free banking system in the 1820s, say, you had banks that had specie reserve ratios of 2% or less, even back then, because of efficient clearing and because they also used some non-gold assets for settlement. They would use a gold for small change and exchequer bills for the big stuff. But in any event, yes, with netting, very small reserve ratios can handle a large volume of interbank exchange.
Yeah, where I struggle with that, George, is I've looked at the H3 data, and in 2007, as an example, there were only 9 billion, a little less actually, 8 billion in electronic reserves. So the 40 billion worth of reserves that you see, on like a Fred chart, that included vault cash. And I struggle, with I'm not saying this is your argument, but I struggle with an argument that would say, well, they're just sending green pieces of paper back and forth in Brinks trucks in 2007.
No, they weren't. They were
Electronic.
doing. That's right. It was
But
only
they only
the.
had 8 billion, and we're talking about a global dollar economy. I mean, there's 35 trillion in the global economy in 2007. So we got 9 billion to actually settle. And I don't see how the math works even with net settlement.
Well, first of all, you can't go by the total dollars outstanding. You have to look at the volume that's processed every day. And again, I can assure assure you, if you look into it, you will find that no bank just sat on a rival bank's IOUs instead of sending them in for payment. That's an established fact that we can easily look at that. And at the end of the day, the banks had to settle. They always did.
Well, they
If
did,
they
but I
had
don't know that
to,
they had to settle on the Fed's balance sheet.
yes, they did. Most of the settlement was on the Fed's balance sheet using the reserve balances that they had at the Federal Reserve.
Okay,
That's right.
I'll
Those
I'll
are part of
that,
the reserve
I just
balances.
find that really difficult to get my head around with only 9 billion in reserves.
Yes, well, it happened. It really
Okay.
did.
How
Yeah.
did the Fed drop rates from 1980 to 2007? Because the way I understand it is the argument is in order to get the Fed funds rate down, they just had to add reserves. Because if these banks are lending reserves back and forth every single night in
Yeah.
the settlement process, then in order to get interest rates from, let's say, 18% down to 5%, we're talking 1980 2007, then the Federal Reserve would have had to inject a lot more reserves to get that interest rate down, assuming that demand for those reserves stays the same.
Yes, well, that last assumption is key. Remember that the high interest rates at the beginning of the period you're talking about are high mostly because of inflation and inflation expectations.
Right.
So this was and rates fell because inflation came down, not because the Fed was pushing more money. In fact, when the Fed was creating a lot of reserves, is when the inflation was getting worse. So oddly enough, or perhaps seemingly paradoxically, it was the tightening of the reserve market by raising interest rates. And when they peaked at 18%, that was Volcker tightening up. What that eventually did was to break the back of inflationary expectations by creating a recession, of course, in 1982.
Yep.
And as those inflationary expectations declined, then interest rates could come down because of less expected inflation. But all this was brought about not by a loosening of monetary policy, but by tightening it in the early 80s at great cost. So this was not a case where interest rates were lowered by increasingly large injections into the reserve market of fresh reserves. And in fact, that would have ultimately fueled more inflation and made rates not only stay up, but continue to rise if the Fed had kept doing that.
Okay, let me say it a different way. We've got M2 in the United States. We'll just use that as a proxy, going from 1.5 billion in 1980 to 1.5 trillion to 7.5 trillion in 2007. And the amount of electronic reserves decreased from about 30 billion to 9 billion. So,
Yes.
and the credit creation, by the way, if you look at bank credit, increased at a more rapid rate from 1990 to 2000 than it did post QE. Let's just say from 2010 to 2020. So, if you have, I would assume demand would massively increase for bank reserves if you have that type of credit creation and that type of, let's say, M2 money supply growth, using that as a proxy.
Yeah.
But the actual amount of bank reserves, like we said, decreased from, call it, 30 to 9. So
if you look into that history more, you'll find there were big changes in the market for bank reserves, including the reduction in bank reserve requirements, and either officially or unofficially through banks resort to sweep accounts, which is very important.
Yeah.
So what banks were indeed able to do, which you mentioned as a possibility, was to make do with fewer and fewer reserves, especially through most of this was happening in the late 1990s, early 2000s. So the demand for bank reserves, the real demand for reserves, did indeed decline, allowing banks to get by with and do what they settle with many fewer reserves legally, to get by with many fewer reserves relative to their outstanding dollar liabilities. So this absolutely was a change in the institutional and legal reserve market framework that allowed what you described to take place.
Yeah, just for the audience. So I want to make sure that they're focusing not so much on the reserve requirements in creating the demand or lack thereof for the bank reserves themselves, but more so the settlement. So
Yes.
we've got to assume that the settlement demands would increase if M2 is growing by that much and bank credit is growing that much. And we're not even talking about globally. We're just talking about in the United States.
That's
So
right.
we have,
Holding lead. Pardon. Yeah.
I'm just saying we have to figure out how in that environment of M2 growing, of bank credit growing, not only in the United States, but globally in terms of dollars, how the amount of reserves that were in demand could decrease.
Indeed, you're absolutely right. Had there been no change in legal reserve requirements or no technological innovations like sweep accounts, by which banks were able to skimp on reserves or make any existing quantity of reserves go a lot further than it did earlier, you would have expected the real demand for reserves to rise proportionately, well, not strictly proportionally because of scale economies, but still they would rise proportionately with the amount of settlement activity and all that. That's exactly right.
It doesn't really apply to the bank reserves, right? If we're just transferring a deposit liability, they've got to settle. That doesn't really impact reserves.
The demand for bank reserves, especially at the Fed, legal requirements aside, is fundamentally a precautionary demand and a settlement demand. So banks are only holding these reserves for their interbank transactions. They don't need them for anything else. So fundamentally, what's driving the real demand for reserves is the scale of transacting banks have to do with other banks and the volatility of those transactions, the unpredictability of them, which is very important. So anyway, for all those reasons, you would expect the demand for Fed balances to be a positive function of interbank transactions, gross transactions. And so they would rise as those transactions rose.
That's my point.
That's right. But that's assuming you don't have technical, legal, and other innovations that can shift the demand schedule independently, for any given level of transactions. And in the 1990s and early 2000s, we had a number of very important innovations that did cause the demand schedule for bank reserves to shift a lot down. I actually do a couple. I'm not sure, George, whether it's in the version of the paper that's online or not. I wrote an appendix to the paper. I had two different periods I applied my intermediation theory to, periods that should have been tough ones for me to justify that theory with.
Like the 90s.
And I think I did the 90s and I did the 2000s, and I talk in those about the changes in reserve requirements, things, and show how the pattern of reserve demand or settlements, I can't even remember exactly what statistics I used to make the point, how it actually, the data fit very, very well once you took all of the changes that were going on into account.
Josh, can you do me a favor while we're talking? Can you grab George's paper and put the link in the chat, and also put the link in the description of the video and the pinned comment when we get done, because it's a pretty short read. I think it's only 40 pages or so. And
it depends who you ask nowadays. Some people think a tweet is about all they can handle.
yeah, but it's very, very good. And it goes, I just wish the people that wrote the paper that you referenced would have dove into the settlement process, because for me, that's where the rubber meets the road. I mean, nobody disagrees that banks can create assets and liabilities. Like nobody disagrees.
No one has ever denied that, and they kind of tried to say that they were proving it. There are a number of these authors out there. I won't mention names, but one guy in particular makes great hay out of the fact that he went to a real bank, and by gosh, he found out that they were creating their loans and liabilities just like
he's,
that.
He's a good friend of mine, George.
Okay. No one ever denied it. No economist ever denied it. We all know what banks do. We all know they write up loans. They don't, but the point is, it's what goes on after that you've got to think about. And you're absolutely right, Jacob and Kumov. I was absolutely shocked. The word settlement shows up once in their paper, but it's in the context that has nothing to do with what you and I are talking about. Otherwise, the paper is completely, utterly innocent of any acknowledgement of the fact that banks have to settle up with one another once in a while, at least, if not continuously. They never talk about it, and I don't think they could, because once they started heading down that road, I think they would have had to rethink much of what they were arguing. And that's part of the point of the paper, my paper, is to say, well, let's go down that road and see just how much trouble it causes for their theory.
Yeah, to be clear for the audience, the debate here should revolve around how banks settle these interbank transactions, and whether or not in the process of, let's just call it net settlement, George, they're actually always 100% of the time using bank reserves or the Fed's balance sheet. That's how I look at it. They're settling on the Fed's balance sheet.
That's right.
Or is it a 50-50, or is it a 90-10, where they consider settlement good just so long as they have received IOUs from JP Morgan. Just using
right, whether they consider that adequate and don't need to go and grab, turn them in exchange Correct. For Federal Reserve dollars.
Right. That's so right. That's really the debate here that I think people should be having. And I just wish, I don't know if you did it for your paper, but I just wish we could get like a group of bankers, and I don't even know what job title this would be, like chief settlement guy or something, at HSBC or JP Morgan, and say, how do you guys do this? And then even, if it was an old school guy going back prior to QE, that's what I'm really fascinated by, because in today's world with what, 3 trillion in bank reserves or something like that, I still lean towards the thin air deal, because the way I look at it, George, is I just going over what I said, it seems very difficult for them to settle. So my position is that they were likely settling, not all the time, but part of the time they were likely settling in a way that just involved their balance sheet and not the Fed. And so the way I think it through, I say, okay, there must have been a reason for that. If you look at a cost benefit analysis, to your point, there is a cost because you have an additional risk. So there must have been some benefit to that. This is just my hypothesis. So assuming that there was a benefit to that in an environment now where we're flushed with reserves, there still might be that same cost benefit analysis, which would incentivize the banks to settle or have the option, let's say, of settling on their balance sheet instead of the Fed if they so choose. And I think that really matters. People might be saying, well, George, why is this such a big deal? Why, George Gammon, why do you want to get to the nitty gritty here? Because everybody thinks that the Fed's balance sheet equals liquidity, global dollar liquidity, that's what it equals. And there's an argument there for sure if everyone is settling 100% of the time on the Fed's balance sheet. But if they're not, then you've got to take that into consideration and say maybe the Fed's balance sheet doesn't necessarily directly equal global liquidity, and maybe it has more to do with just, let's just say, perceived counterparty risk. That's how I usually say it in my videos, George.
Well, there are a number of things you can do and look at in order to see, get some sense of how much of the alternative possibility you described goes on. If you go back before 2008, the mere fact that that banks were constantly dipping into the federal funds market suggests that they needed to settle. But it's also true that they often did that to meet legal requirements, even when they these went beyond their settlement needs. So it's not a pure test. We can also look at banks' actual balance sheets to the extent that you're able to get information on them to see what items what liabilities they have on hand and how many from other banks. Banks always have some liabilities on hand from other banks. They used to call these items in the process of collection, which was a way of saying we're not holding on to these very long, and they didn't. But that's the other thing you could look at. And you can look at the sheer volume of gross interbank payments to see just how big that is. That gives some idea of how much banks are transferring to each other, at least of their liabilities, which is not the same
And
as
you'd
the
have to
amount
get
of.
that for the offshore banks too, because I mean that's where, in
Yes,
my view, where the
yes.
majority of the dollars are created is in the Eurodollar system.
Well, that's right. They're certainly part of the story. Absolutely. You wouldn't want to ignore them at all. But all of these things would be worth looking into. As far as I'm aware, banks don't accumulate liabilities, one another's liabilities, to any important extent. Now we should be careful here. Banks do borrow from other banks all the time. But what we're talking about is the extent to which they passively acquire liabilities in the
Yeah,
process of
yeah, yeah.
gross interbank transactions, where they end up uh, uh, with an IOU from another bank and just say, well, that's all right. I'm going to hold on to this. I'm not going to ask you to convert it to
Yeah,
pay it off in
there's a
Fed
time
funds.
component of the debate, right?
Time
As far as
component,
settlement, because do
and
we have
also,
to settle? Like, if I've been doing business with you for 40 years,
yeah,
do we really need to settle every
yeah.
single night with bank reserves, or can we say, you know what, George, I know you're good for it. Let's just do it in 2 weeks.
Yeah.
Or,
In the paper that I referred to that Larry and I wrote, we talk about this tendency for banks to, in fact, settle up regularly as having evolved as a sort of tit to tat equilibrium in a game theory, in the sense of game theory, where in those days there were possibilities banks had to concern themselves with, not only that they might accumulate IOUs of another bank and then that bank fails, that's one risk, but also if a bank accumulates IOUs of other banks, it's making it easier for them to accumulate IOUs on them.
and then they
And
give them a margin call if they wanted to go bust.
yes, exactly. And that happened in the old days. Banks would try to accumulate other banks. They'd get a war chest of IOUs on other banks, and then they'd spring them all on them at once in the hope of bankrupting them. And that was true. This has really happened. They called them note raids because they were paper notes in those days instead of, they were actual paper IOUs issued by banks. The banks learned that for their own sake, they'd better present items regularly of rival banks, lest those rival banks should be trying to accumulate a war chest against them to make it hard for them to do so. This was a long time ago, George, so I don't want to stretch this to say, well, that explains why they don't do that today. That would be a little bit much because I'm talking about, 1770 in that period. But in any case, the habit or the institutional arrangement evolved that way. And the next thing you know, you had banks first settling every week and then every day, and finally, sometimes more than once a day. And now, of course, technically, we have a lot of real time settlement that goes on, real time gross settlement, where there's no netting at all. Every payment is supposed to be paid off fully in Fed balances. The Federal Reserve pretends to do that. They call their system, their wholesale settlement system, real time gross settlement. They don't really do that because they allow intraday overdrafts. But at the end, which is the same as saying you don't really have to pay right away. But at the end of the day, the banks have to have greater non-negative reserve balances on hand.
Yeah, I like to look at it. I like to start, well, maybe not start, but part of the analysis that I do, or my thought process, is I like to think about why the Fed can't go bust. Because obviously they can have negative equity. They have negative equity now. And I forgot how they offset it on the liability side of the balance. It's like future.
With a deferred, they create something called a deferred asset.
Deferred asset, that's what it is.
Yeah. So what we would call a loss, they call a deferred asset, money that they haven't made yet,
Right.
but they're gonna.
But from a mechanical standpoint, they can't go bust because they never have to transfer that deposit liability. Right? They never have to transfer the deposit liability to a different bank, and therefore they technically don't even need assets.
Well, right? Because the Fed is distinct from J.P. Morgan in creating the economy's final settlement media. They can also ultimately create whatever they owe anyone ever, right? They can always create more. Where the Fed, where it matters if the Fed loses money is that if it loses enough, it's going to have a hard time dealing with that while maintaining keeping it to its duty of limiting inflation, right? So if the Fed didn't have to worry about inflation, it's pretty obvious that it doesn't have to worry about its bottom line because it can create all the final means of payment necessary. But if it's got to worry about inflation, then its income statement starts to matter in subtle ways.
But I look at it from the standpoint of settlement, just focusing on that. And the Fed never has to settle with another bank because they're just transferring deposit liabilities from JP Morgan's account to Wells Fargo, let's say.
Yes, you can look at it that way, or you can say the Fed doesn't have to worry about settlement because it creates the economy's final settlement media. It does create settlement balances or settlement media for it out of thin air. Only the Fed does that. Other banks, including JP Morgan, can't create Federal Reserve final dollars.
Right.
That's an important difference.
Right. So let's just focus on the settlement there as far as that. I look at if you had, so you got one balance sheet, and this also Gazbank too. I'm sure I found that interesting looking at Russia, where they basically had a CBDC. Everything that we were concerned with as far as the CBDC, they had it because the way I look at it in my head, it's just one ledger. Because if you just have one bank and that bank is the central bank, and therefore they never have to settle with another bank. To your point, they can create as much money as they want. They never have to transfer it. They literally cannot go bust. And then they can track every single transaction, and they can issue credit not based on merit, but they can issue credit just based on, let's say, narrative. That's usually the way I say it. And the reason they're able to get away with that, in my mind, is because there was just one ledger. And so with the Fed's balance sheet, there's just one ledger. So I think about what it would take, not that this is the way it's happening, but what it would take to replicate that with global dealer banks, let's just say outside of the United States. And then I think, okay, if we just had two banks, and I'm taking it to an extreme, but if we just had two banks and therefore two ledgers that were connected with a network, and there was, let's just say, equal risk between the two banks because they know each other, then effectively you would have that same one ledger type of system.
Yes, I think that's right. Or just let's assume that one commercial bank established a monopoly. The Fed's still there, but the one commercial bank buys up all the other commercial banks. So now you have one big bank. All of our transfers, all of our transactions result on what the bankers call on-us items. That is that, one depositor has made a payment to another depositor. The bank just has to adjust the balance sheet, debit, credit, doesn't have to move any reserves, and certainly doesn't have to have an outside source of reserves. In principle, that bank looks a lot like and operates a lot like the Federal Reserve. Although it can't create the economy's final reserve medium, it doesn't have to for any purposes if we stick to this assumption. Now, if people start coming asking for cash, that's going to cause a problem in the system, assuming the Fed alone creates actual Federal Reserve paper dollars. But apart from that, you're right. You'd have like a parallel private central bank operating in place of or next to the actual one, with no specific need for central bank reserve media for settlement. and that's why monopoly is really what matters here.
I
Monopoly
was going to
versus
say
competition.
that's exactly what I was going to say. So the
Absolutely
more
essential.
consolidation you have, the less settlement you have. You
That's
need,
exactly.
and
That's right.
therefore the more risk they can take with the balance sheet. Yeah.
That's right. As you know, George, I'm a long time have a long time interest in free banking. So far be it from me to 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 argue as if it didn't matter how competitive your private banking system is. It's extremely important to my argument. A monopoly bank would look a lot like a central bank in its ability to rely on thin air, let's say.
Yeah.
And so obviously I'm not talking about that sort of system, a monopoly. But neither Cunliffe and Jacob or the other critics of the intermediation view. So since they're not appealing to a monopoly, I don't think their arguments are sound. They would be if they were saying, oh, let's just assume one bank. There are times when they argue that it doesn't matter whether you assume one bank or not, but that's because they're overlooking settlement.
Yeah. I guess using those terms, my base case or my hypothesis is that there isn't one monopoly bank, but there is one monopoly set of ledgers that create this network of global dealer banks that effectively act in a parallel system in a similar way to a central bank that gives other banks the option to settle off the Fed's balance sheet at a lower cost, but maybe, or at a lesser time. And therefore, the additional risk taken by making a net settlement with one of these global dealer banks still makes sense because
Right.
the benefits outweigh the cost. That would be my hypothesis.
That's right. And it could be most of the time in most industries and banking fits, we don't have atomistic competition and we don't have an outright single monopoly. We've
Yeah.
got something a little bit messier. And then it becomes an empirical question, what model fits it best? One that says, well, this is kind of like competition, or one that says this is kind of like monopoly. So you've got a hypothesis that comes with an empirical question. This is the U.S. banking system in particular one that hypothesis is relevant for, or are we after all doing fine if we treat it as a more or less competitive industry where the banks are jealous rivals? And this is where going into the nitty gritty statistics can shed light on which position is correct. I'm pretty confident in mine, but I would not call your hypothesis one that should be dismissed out of hand. It's worth exploring, and maybe one can unearth some evidence that there are indeed important cases, or maybe quantitatively important, that banks often do just hold on to one another's IOUs,
Yeah, I'd love to see
and,
a.
and
You'd think,
reduce the demand for settlement media, Fed settlement media by doing so. It's
yeah. Sorry
possible.
to cut you off there.
That's all right.
You would think that the BIS or something would come out with like an exhaustive like report on exactly, this happens first, then this happens, then this happens, or if this happens, then this happens, kind of like a like a flow chart almost to give us some insights as to what the possibilities are and then maybe what the percentages are. And I think it would be incredibly useful, and I'm shocked that they don't have something like that, or maybe I just haven't found it.
I think they haven't done it because they assume what I assume, or at least, or maybe they know what I know. If I'm right, it's possible that they're overlooking the possibility that you're raising too. Um, I, I just, there are some interesting papers out there that can, I think, shed some light on this. I just wrote another working paper, just put it up online this weekend. Uh, this is about Fedwire and the National Settlement Service, which are involved in most of the settlements that we've been talking about in the United States. And it goes into some detail about how these how these procedures work. It's not going to give you the slam dunk statistics one way or the other to settle this matter. But at least it provides some more institutional background, check clearing, ACH, which is the automatic clearinghouse, FedWire, National Settlement Service, and all that stuff. But it sounds like you've got a research question cut out and worthy of investigation.
Yeah, too bad I'm almost illiterate, George, or else I do the. I'm basically illiterate and I have ADD, so I can't do any of this research myself.
I think you're being a little rough on yourself, but you can always take on a research associate.
That's what I need.
Work on it with you.
That's what I need.
I'm illiterate in a lot of things, and when I want to write a paper that requires some horsepower I lack, I just find somebody to work on it with me. It's not that hard. I don't do it very often, not because I always have all the horsepower I need, but because I'm pretty careful to cut out my research projects as to make them fit the horsepower I've got.
Have they rolled out FedNow yet?
Oh no, FedNow is already exists. It's been up and running for a while. What they have apparently ruled out, and by the way, they're subsidizing the hell out of it in subtle ways, which is very unfair to the private rival RTP. But what they have ruled out is publishing any volume statistics. Now, you know perfectly well that if it were really, really selling like hotcakes, they would be telling us they'd be skywriting it. So I think it's just not. I don't think they're moving very much money with FedWire at all. I think I predicted long ago that it would be something like something of a white elephant. And so far, my impression, because we don't have statistics, is that I might be right.
And then CHIPS is basically an alternative for FedWire. Is that?
No. Well, CHIPS is a private clearing system.
Yeah.
They used to be more important. Now they handle they focus on international transactions, Interbank and other things. They are part of the old New York Clearinghouse, now known as simply the Clearinghouse, or TCH. And TCH runs the rival to FedNow, and the one that came sometime before it, several years before it, called RTP, which is the first U.S. Retail real-time payment system that's at least potentially capable of connecting all banks. So CHIPS is very important, but it's not quite as important as it used to be for settlement. And it deals a lot with foreign to U.S. settlements.
Got it. George, I can't believe we've been talking an hour.
Oh, how about that?
That is incredible, man. That's has really been a treat. It really has.
For me as well, George. And I've heard a lot about your show over the years and seen a few episodes. So I'm quite honored to finally be part of it. It's been fun.
We're gonna have to get Bob on here next time and see if there's something we can all argue about.
You want to make a threesome out of it? Is that it?
We'll have a three-way debate with something we all disagree on, and we'll come in here.
That could become a mess pretty quickly.
All right. So, George, where can people go to find out more about your papers, maybe the recent paper that you just wrote? Can they go to cato.org?
They can go to Cato. They can go, if they type in my name and Cato, they should find all my working papers and other stuff. And I didn't get a chance to say it, so I'll say it now. My big thing in the works is a book I have scheduled to come out, University of Chicago Press, March 2025, called False Dawn, The New Deal and the Promise of Recovery, 1933 to 1947. It's the true story of how the United States got out of the Great Depression and what the New Deal contributed to that recovery. And you can pre-order it if you want to and save a couple bucks.
That's fantastic.
On Amazon.
Yeah, and by the way, when that book comes out, don't hesitate to email me and come on, and I'm happy to promote it. Anything I can do to help out.
Oh, thanks very much. I'll be talking up a storm about it on Twitter. You won't miss it. You'll know.
All right,
But,
sounds good.
yeah.
And guys, on that bombshell, I want to remind you to make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you on the next video.
Bye, George. Thank you.